All right, San Diego, good morning. We just had another great week of radio shows, and we're bringing it all here this morning for you on the American Dream. Let's get started.
I go to battle for you every day to combat the nonsense in the mainstream media. They're more interested in sound bites and sensationalism. I'm interested in the truth and being your consumer advocate. My ultimate goal is to help you win in any marketplace, and I'm bringing an edge in the real estate and financial game. My name is Craig Sewing, and this is the American Dream.
Thanks for joining us for your sports headlines. I'm Koshal Patel. If the Chargers leave San Diego, don't expect another team to take their place. That's according to NFL's executive vice president, who said, quote, if you have a team, you should do everything to keep it because the backfill is a low probability. This comes as a task force appointed by Mayor Faulkner is working on a plan to build a new Charger stadium in Mission Valley.
My confidence is dwindling on our Charger staying here. I had lunch the other day with an ex-Charger, and he told me they gone. So I hope that they stick around, but the debate between the city and certainly the team is not looking good, but we'll certainly keep you updated here. We've been talking a lot about that on the radio show. It's a good reminder that everything we do here on the American Dream and on my radio show weeknights at 6 p.m. on 1170 AM KCBQ, it's centered around the city of San Diego. I'm your consumer advocate. A lot of things we talk about have to do with your finances, your real estate, and facilitating introductions to experts here in the marketplace. So it's always a good reminder that this is a San Diego-based show. But we do talk about some national topics as well. This week on the radio show, all of our uploads can be found at craigsewing.com. We talked about the market hitting an all-time high, inflation ticking up a bit, got into the presidential election as now Ted Cruz has thrown his hat in the ring. It's our first candidate, and we dove into the SeaWorld stories. They're trying to rebrand themselves and strengthen their image. So I always encourage you to make sure you tune into that show. It's every night, 6 p.m. We also have a 7 p.m. show with some of our elite hosting their own shows following me. And of course, if you have questions, if you have anything that you need, you visit me online. There's a contact form, and we can guide you. Let's go ahead and take a look at some of the things that happened in the marketplace this week. So, as I already stated, inflation ticked up a bit. That's the devaluing of our dollar. That negatively affected interest rates. We're going to comment on that with David Reyes in our market report here in just a minute. The market was down on Tuesday when we saw that happen, and we saw that new home sales were up. It seems like the volatile swings are back in the market. Now, this makes it tough. We always talk about the economy out there, and then there's the one between your own ears. That's where I want to give you some guidance. I think the most popular topic you're hearing about right now has to do with interest rates. Now, there's a big difference between short-term interest rates and long-term interest rates like you see on mortgages, and we'll be diving into mortgage rates a little bit later, but let's focus right now on short-term interest rates, what the Fed is doing, and what that could mean towards your financial plan. Here's a video from CNBC this week.
You're making some of the first comments about the FOMC's recent policy statements since the statement came out on Wednesday and the conference and the press conference by the Fed chair. Evans saying that he's comfortable with the removal of the word patience, even though he is one of the more dovish members of the FOMC.
I would say it could easily be consistent with us not raising rates because conditions evolve in a certain way for quite some time. Or it could be consistent with raising rates in June if the circumstances warrant.
Evans believes that inflation will remain low even as the unemployment rate comes down, and he made a very strong case for the Federal Reserve to aim or allow inflation to run above the 2% target.
Now, what's really interesting about that is that video was from Monday, and inflation ticked up a little bit on Tuesday. So it just seems at some point in time we're going to see inflation. We have a lot of stimulus that's been injected in this economy. We have short-term interest rates at 0 to 0.25%. You've heard things like printing money. So here to help us understand what that means, why you should care, David Reyes with the Reyes Report. David, good to have you on the show. Let's start there. Let's start with the inflation topic. Tuesday ticked up a little bit. We've been warning about this for quite some time, but you're also hearing things like deflation and stagflation. It all gets very confusing. What's it mean, and what does it mean for the people watching at home today?
Well, it's the first time, Craig, that the inflation's actually ticked up in about 3 months. You saw gas prices up for the first time in a while. Oil stabilized. You saw housing. New home sales were up 7.8%, as you mentioned, the highest since 2008. and inventories are shrinking. So it's good news for builders. Building stocks soared. Am I concerned about inflation? Quite honestly, not at this point in time. And it's mostly because of energy. I mean, if oil prices stay where they're at, I mean, we had oil in the mid 30s in the 2008. So that's kind of the bogey for the downside that I think is going to protect us against inflation. And you still have the world economy. Japan, China is reducing interest rates. Obviously the EU, the European Union started their tapering. So, my thoughts are, I think GDP growth is going to be lower in the next quarter. So, I think interest rates are probably going to fall. Markets really still poised for a drop. And I think you'll see bonds rally on that next fall in the market.
So, David, when you saw that inflation tick up on Tuesday, I think that creates a little bit of fear in the market that it's going to cause the Fed to raise interest rates. Is that a fair statement?
That's a fair statement.
So the market doesn't want the Fed to raise interest rates because the market likes low interest rates. So if you're sitting at home right now and you're looking at your 401k plan or your overall financial plan and you're trying to gauge what are some of the things that you should do, what advice would you give in a market like we're in right now with short-term interest rates where they are, this confusion around inflation and all these other topics we continue to hit on Saturday mornings every day with you?
Yeah, I mean, you heard the first segment of that video roll that you did, and they were talking at every word, patience and what is the Fed. I mean, I had a printout of the highlights and the red line of each word of the Fed changed. I mean, it's quite ridiculous right now. And you said the key word, Craig, is plan. You better have a plan. That's the key. If you don't have a plan, which unfortunately most people don't, it's kind of they're winging it. And we'll talk a little about 401ks here in a minute, but the key is, who knows what's going to happen. My whole opinion is that I'll see it when I believe it, Craig, when the Federal Reserve does raise interest rates. It's just tough to do with this inconsistent economy. You got numbers coming out every other day, Craig, that are different, that are counterintuitive. And so I'm kind of a wait and see guy. They're talking, July maybe, a June raise. But again, I'm pretty cynical about them raising rates anytime soon, in my opinion. But that's my opinion.
Outside of the show, you're a brilliant financial advisor. People go to you all the time from our radio show. You host your show on KFNB. A lot of the advice you're giving is on people's 401k money. Let's take a quick look at a video around 401ks, and I'd love for you to advise when we come back. Let's go ahead and roll tape.
To make $1 million, to have saved $1 million. The number of workers who have saved $1 million or more in a workplace retirement plan is at a new record, having doubled in the past 2 years, according to Fidelity Investments, the nation's largest retirement plan provider. And many of Fidelity's 401k millionaires made less than $150,000 a year. Their success isn't purely based on stock market gains. They are serious savers. They started early, giving them a powerful advantage thanks to compounding. They generally started saving at 25 and plan to work until 67.
All right, so let's bring this home to San Diego. David Reyes, Reyes Financial Architecture. You have a gorgeous office in UTC. I've been there many times. Someone goes, sits down with you. They want to look at their 401k plan. What advice are you giving them?
Well, in that video you saw that, we have a record number of millionaire IRA and 401k owners. And my advice is right now is if you're in or near retirement, you want to look at ways to protect that. So we're doing lots of transfers out of existing 401k plans, Craig, in the sense that we're at 59 and a half. One of the great pieces of advice I can give you, 59 and a half or older, you actually can move that out of your 401k plan and have professional money management done for you to help protect those nest eggs. So that is a big trend we see right now, where we're having people move money out of existing plans. They're still working, but now they can have the expert advice that they need.
So 59 and a half or higher, is that what I heard?
Correct.
Okay. It's kind of like when you're a kid and you're excited. I am 4 and a half.
Yeah.
So 59 and a half.
Big kid.
If you're on the upper side of 59, then, well, really anybody should reach out to you. We've introduced so many people from our shows and friends and family to Reyes Financial Architecture. And the important thing that people understand is that you will sit down with them and give them advice. You are accessible. In fact, you have a review that you do that costs $2,500. You can connect with David by going to reyesplan.com. As a viewer of this show, the first 5 people that are able to send a text message, if you are willing and able, David is going to waive the $2,500 fee that he would typically charge for consulting with you and helping you. That shows how valuable it is. He's going to give it to you for free. If you are able to just send a text message right now, we're going to take the first 5 people and we will facilitate the introduction. The number is right there on your screen. Just text free review That comes directly to me. I'm going to ask for your name and email. I will introduce you, and you've just got a $2,500 gift for free on a Saturday morning. And not only is the gift itself free, imagine being empowered to know when your retirement age is, or being able to reduce that retirement age or increase the amount of money that's going to come when you do retire. So wonderful gift. We appreciate David Reyes doing that. We appreciate David for coming in here and doing the Reyes Report on Saturday morning. Thanks, David.
Thanks, Craig.